Hey everyone, and welcome back to the channel. So, you have $50,000 in savings, and you're considering real estate and wondering, is this even doable? With interest rates being where they are, it can be a pretty scary thought. Well, I'm here to tell you not only can you do it, but I'm going to take you step by step through exactly how I would invest that $50,000 in real estate right now. We're going to look at some of the highest leverage tools that multiply your buying power, go over risk management, and I'm even going to show you a way of recycling that same $50,000 repeatedly. Tune in, folks, because this is going to be a wealth-rich deep dive. All right, let's dive in. This isn't about just going out and buying one rental property the conventional means. With $50,000, we must be strategic, resourceful, and use leverage to our maximum advantage. We're in a high interest rate environment, and that is not the same. So today, I'm sharing proven techniques to not only get into the market, but really maximize returns and build real wealth without taking on complete crazy levels of risk. Okay, so let's address the elephant in the room, interest rates. Right now, the typical rate on a 30-year residential mortgage is approximately 6.43%. And if you want to finance a property in the future, that rate is even greater, approximately 6.7. That's a big deal because it has a strong influence on your cash flow every month. That large mortgage payment can swallow up all of your rental income without your ever laying eyes on a dime. That rate truth is the very same reason that the conventional strategy of putting 20% down on an investment property is as hard as it is today. To make $50,000 work, we have to get creative with owner-occupied financing or use capital recycling methods in order to keep our capital in motion. Now, most new investors do a huge mistake. They worry about the down payment only and never think about the secret killer, closing costs. These are not insignificant charges. Closing costs will eat up 2 to 6% of the price of the property. I'll give you a real-life example. We're dealing with a $350,000 house with a 3.5% FHA down payment. Your down payment would be $12,250, but your closing fees, a mere 7%, could be another $21,000. And you surely need an emergency fund, let's say $10,000. So that affordable home now takes over $43,000 just to get in the door. That is why budgeting for these sneaky fees is not a choice. It is what makes good deals from financial disasters. Your credit score is your ace in the hole, or your worst nightmare. Look at it as your leverage accelerator. To be able to get the strongest loan for the small investor, the FHA loan with a mere 3.5% down payment, you have to have at least a FICO score of 580. And your score is 500 to 579, that down payment rises to 10%. To us, with a very tight $50,000 budget, that's a complete game changer. Putting 10% down reduces the price of the property you can purchase by a huge amount. So having your score above 580 is non-negotiable. It's the key to the lock that opens the door to maximum leverage. All right, so let's go into the first powerhouse strategy, house hacking with an FHA loan. This is, without question, my top recommendation for someone starting with $50,000. What do? You purchase a small multi-unit property, say a duplex, triplex, or fourplex, with an FHA loan. That's only 3.5% down. Then you live in one unit and rent the others. You're a homeowner and a landlord at the same time. The rental from the other houses pays a substantial part, even the entire of your mortgage. You're chopping away at your housing expense while your renters build wealth for you. Let me show you how powerful this is. Check out this chart. A typical investment house with a 15 or 20% down payment might let you buy a $250,000 property using your $50,000. But an FHA house hack? It can create an asset worth $600,000 or more. You're employing your $50,000 to control almost triple the cost of an asset. You get to be a player in more expensive, appreciating markets that are otherwise totally unaffordable. It's the superior way to turbocharge your real estate start. Now, if you're hands-on and you want to grow quickly, you should read about the BRRRR Method. That's an acronym for Buy, Rehab, Rent, Refinance, Repeat. The method is all about taking your $50,000 from being a stagnant cash pool and turning it into a revolving line of credit. This is how it works. You buy a fixer-upper with either cash or a short-term loan. You then rehab it, forcing the appreciation and growing its worth. Then you rent it out to a good tenant. Next, you perform a cash-out refinance based on the new greater worth, which pays back the original money you invested. And finally, you repeat the cycle and invest that same capital in your next project. Let's make this concrete with some figures. Let's say you buy a distressed home for $100,000. You use your own money for a down payment of $15,000 and close on a hard money loan. And you spend $35,000 on repairs. Cash outlay total, $50,000. The property appraises at $240,000 after it has been renovated. You then approach a long-term lender and do a cash-out refinance of 75% of that new value. And you get yourself a loan of $180,000. You use the $180,000 to cover the original $100,000 loan and the $35,000 in rehab expenses. After financing charges, you may end up getting around $40,000 into your pockets. You now own a cash-flowing rental property in your name, and you've got the majority of that initial $50,000 back to repeat the process. That is the magic of capital recycling. Being a landlord and rehabbing may not be your cup of tea, and that is absolutely fine. You can still invest that $50,000 into real estate passively. The simplest of all is through publicly traded REIT ETFs, like the Vanguard Real Estate ETF, VNQ. You have instant diversification, expert management, and sell and buy shares just as simply as a stock. The return is roughly 3.76%. There are crowdfunding platforms, like Fundrise, where you can start with as little as $10 and invest in larger, institutional-grade properties. And for the bigger commitments, there are private syndications, where you are a silent partner in a specific property transaction, but your money is typically committed for 3 to 7 years. So let's just compare these passive options briefly. REITEFs have the lowest barrier of entry. You can start with the price of a share, and they're daily liquid. Crowdfunding platforms like Fundrise have small minimums, but your money is not as liquid, typically with quarterly windows of redemption. And private syndications have larger minimums, generally $25,000 or more, and your money is tied up for years, but they typically aim for higher return. It's all a trade-off between return, control, and liquidity. Whatever direction you go, you need to be proficient in real estate math terminology. 3 measures are absolutely indispensable. First is cash-on-cash return, your yearly cash flow divided by how much cash you invested. For the leveraged investor, it is the most important number. It tells you how hard your money is working. Second is the capitalization rate, or cap rate. This is the property's return free of debt, and it's great comparing different properties level to level. And third is the debt service coverage ratio, or DSCR. This is the ratio that lenders use to verify if the property income can comfortably cover the mortgage payment. They always like a ratio of 1.25 or higher. I'd like to double down on cash-on-cash return because to you, with $50,000, this is the king of all metrics. While cap rate is useful and DSCR is necessary for your lender, cash-on-cash is the one that informs you if your leverage strategy works. It quantifies the productivity of your limited capital directly. You should aim to get a cash-on-cash return of 8% or higher. This metric gets past all the hype and informs you if you're truly building wealth faster than you would with a plain old-fashioned index fund. With only $50,000, you can afford no expensive mistakes. Tough due diligence is not merely a good idea. It's your survival kit financially. You need a professional inspection to uncover any hidden defects in the foundation, roof, or major systems. You need a legal and title inspection to uncover any ownership confusion and zone inaccuracies. And you just need to do a good solid financial analysis. Have the rent rolls, check the utility bills, and budget always conservative figures in your projections. Anticipate high costs and low rents. Anticipate things going wrong, because sometimes they will. Now let's address the big risks and how to deal with them. Vacancy risk first. An unrented unit means zero revenue, but all the bills still need to be paid. Offset that by planning for a 5 to 10% vacancy rate in your accounts. And then there's liquidity risk. You can't sell a house in a day like you can with a stock. You need to have an emergency fund separate from your money for investing that you can access on short notice. And finally, there's leverage risk. Debt increases your returns, but also increases your losses. Never borrow more than you can comfortably afford, and always stress your projections. What if interest rates go up? What if you have a 2-month rent gap? One of the best things about owning direct real estate is the tax benefits. The two you need to get to know are depreciation and the 1031 exchange. Depreciation is lovely. It's a phantom expense where the government lets you deduct the cost of the building, decreasing over 27.5 years. It's a non-cash deduction, which is to say that you save tax money without ever laying out a single dime. And of course, there's the 1031 exchange, which allows you to postpone paying capital gains tax upon the sale of a property if you can roll the gains into another like-kind investment property. This is a giant wealth-building device. Let's explore a little further with depreciation since it's such a powerful device. Here's a brief illustration. Let's say you buy an item of property for $300,000 and the land under it is worth $50,000. Your depreciation basis is $250,000. You divide that by 27.5 and you get a yearly deduction of over $9,000. If you're in the 24% tax bracket, that deduction will save you over $2,000 in your tax bill every single year. In a high-rate world where your cash flow is constricted, this tax shield can be the margin between a property that loses a small amount of money on paper and one that brings cash into your pocket after taxes. Well then, where does that leave us in the current market? Sure, there are difficulties. High interest rates compress cash flow and make the deals more difficult to find. But there are real opportunities as well. Higher rates bring fewer buyers. You might get more eager or even distressed sellers. This creates an opportunity for cash investors or creative financing methods, like the BRRRR strategy, to buy properties at a lower cost. It's not timing the market. It's having the right strategy for the current market. Success with $50,000 doesn't happen by accident. You need a system. Begin with your objective. Do you want cash flow, appreciation, or just getting your foot in the door? That will drive your strategy. Second, research markets. Don't think just about your hometown. Look for markets with strong job growth and positive rent-to-price ratios. Third, optimize your financial profile. Get that credit score above 580 and move up your debt-to-income ratio. And finally, always play it safe. Use conservative assumptions and let the cash-on-cash return be your guide. So, to summarize, here are my top 3 for you. Number 1, house hacking with an FHA loan initially. It's the best way to maximize the bang for your $50,000. Number 2, master the BRRRR method for scaling. This is how you make that $50,000 an investment machine that increases forever. And number 3, think single-mindedly about your cash-on-cash return. This will keep you on the straight and narrow and lead you to most effectively utilize your capital. There you have it. With $50,000 and the right strategy, you can indeed build enormous real estate wealth, even in today's market. Remember, success at real estate investing isn't about carrying the most money. It's using the money you have most effectively. Whenever house hacking for immediate leverage, BRRRR for quick growth, or passive investments for diversification may hold for you, you now have a map. The key thing is to just take that first step. Do your research, squeeze out your numbers, and go do it. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.